Public sector banks performed phenomenally well in the March quarter of FY23. The banks made an overall profit of 1 lakh crore and gained praise from experts. It is no secret that our public sector banks had issues for quite some time. To rectify it, in 2019, the central government introduced a strategy to improve financial health. In it, the government focused on bringing in greater transparency, recovery, and reforms. So, how did they go about it? The first thing was bank mergers. From 10 PSBs in 2017, it has come down to 4. In 2016, SBI merged 5 of its subsidiaries with itself along with Bharatiya Mahila Bank. In 2018, the Vijaya Bank and Dena Bank folded into the Bank of Baroda. A year later, the mega merger of 10 banks was announced. Syndicate Bank was merged with Canara Bank. Different banks merged with the Union Bank of India, PNB, and Indian Bank respectively. This series of mergers resulted in creating enough capital for the banks and helped them in expanding their balance sheet.
2018, the year where we started seeing consolidation in the public sector space, because until then we were talking largely about it. One may say it started back even in 2016 with State Bank of India sort of collapsing all its subsidiaries with itself. But what we're seeing today is a result of continuous mergers that we've been seeing over the last couple of years. These are acts that have given the impetus for growth, that has ensured that there is enough capital for all of them to sort of look at, expanding their balance sheets in a meaningful manner. And what it has also done, the timing of this whole merger is very interesting, because when this merger was conceptualized, your NPAs were easily upwards of 8-9%. From there, we've come to sub 5% or sub 4% as NPA at a gross level. For banks like Bank of Baroda and all, it's even sub 3%, which is fabulous.
Secondly, PSBs tackled their mounting non-performing assets. The center introduced a new system to help banks to detect and manage NPAs earlier. PSBs also created a new stress management vertical for effective monitoring of recovery. From 2019, willful defaulters were restricted from availing extra facilities from banks or other financial institutes. The companies with willful defaulters as promoters or directors were also debarred from accessing capital markets to raise funds. These efforts showed results. NPAs declined from 14.6% in March 2018 to 5.53% in December 2022. There has been a marked change in the customer base when it comes to loans. It has changed from corporate loans to retail loans. This means that they are giving out more housing and vehicle loan. They are also giving more loans to the MSME sector. This contributes to more than 30% of PSB's loan book.
In the last couple of years, especially starting 2018, the trend has been towards retail loans. And retail for a public sector bank is pure retail, which is your housing loan, vehicle loan, etc., plus your SME segment and your agri segment, right? All these three put together would not even be 30% of their total book. The books were concentrated so much with corporate loans. Now, what has happened because of, CapEx not picking up, banks themselves becoming a little wary of corporate lending in the last couple of years after the whole asset quality cleanup cycle and all that, is that retail, just as how it is for private banks, is very much the focus even for public sector banks. That is a very, very potent growth tool. Therefore, the NPAs are getting padded up a lot because of the retailization efforts that banks are now taking. Because NPAs are getting padded up, because there is not much provisioning to be made, the financials on an overall basis are looking much better than what they used to be around the same time, five years back, or let's go back to even 4 years. They're looking very healthy because of the change in the loan mix. Now it's 50-50, or some of the banks it's even 60-40 the larger proportion being aligned to retail book. So
There is one more thing you should know. There has been exceptional growth in bank deposits. Now, the bank's financial health has improved. But is it reflected in the stock markets? The answer is sadly no.
there are two parts to valuations as such. One is financial performance consistently doing well. We call it the arithmetic aspect of valuations. The other thing is perception. And perception is largely a function of how markets see or view a particular stock. What is the standards of corporate governance in a particular company or a particular bank? What is the independence of the board? What is the decision making quality and authority in a particular entity? These are aspects that really add up to the second part that I mentioned about, which is the perception of valuations, right? Where public sector banks are lacking is the second part. They've gotten their arithmetics right. Like we just discussed, their numbers are looking as good as private banks. That's not the problem. The fear is that, is the governance still really good? That is a question that needs to possibly find an answer here.